Well, I think what it was, they were shocked that someone had the courage to come forward and, in the first time in history, to expose the largest and longest-running tax fraud in the world. And unfortunately for the U.S. government, that affected some politicians, CEOs, billionaires, and they didn't know how to deal with 19,000 accounts at one institution, at UBS, the largest one. And this was something so historic, they just didn't know how to deal with it, and it really upset the whole organization here in the U.S. government.
What was your motivation for becoming a whistleblower? Certainly, as a banker in Switzerland at UBS, you must have obviously known the nature of the bank secrecy. So at what point did you say, you know what, I need to actually step forward and speak out regarding some of the money laundering that I've seen?
Well, it was not just money laundering. It was a whole variety of nefarious acts that were taking place in Switzerland, everything from terrorist financing to money laundering, tax evasion, insider trading, bribery, extortion, prostitution, drugs, the whole litany of illegal acts. But I came forward because the bank had lied to myself and my colleagues, the clients, and the shareholders of UBS by saying that this business was legal, what we were doing. And I had the courage and the determination to not only complain about it internally, but then to bring it to the head of legal and compliance when they slipped a secret 3-page document in our intranet contradicting exactly what we were doing about this illegal business here in the U.S. So I came forward actually in early 2005 and then resigned later that year, and then went to the United States and started whistleblowing in 2006.
Well, a year ago this month, the Justice Department announced the banking giant JP Chase would avoid criminal charges by agreeing to pay $13 billion to settle claims that it had routinely overstated the quality of mortgages it was selling to investors. When the toxic mortgage securities started turning bad, investors lost faith in the banking system, and a housing crisis turned into the 2008 financial crisis that led to millions of home foreclosures. New York Attorney General Eric Schneiderman unveiled the settlement last November. Meet the woman JP Chase paid one of the largest fines in American history to keep from talking.
In the article, Elaine Fleischman criticizes not only J.P. Morgan's banking practices, but how government regulators at the Holder Justice Department responded to the bank's lawbreaking. Today, in her first televised interview, Elaine Fleischman joins us here on Democracy Now!
Well, when you went to work there, what specifically was your job? And if you could walk us through how you began to realize the huge problem that the bank was a part of.
Sure. I started as what they call a deal manager. Basically, we coordinate between all these different groups when we're bringing in these loans that are then going to be sold to investors. I first noticed that there was a problem when they brought in a new person to do our diligence, which is just the review of the loans themselves to make sure they're of good quality. As soon as he came in, this wall sort of came down between myself and the group that was doing this review, and you couldn't get information that you would normally get. On top of that, there was immediately sort of a no email policy. He wouldn't send emails, and we weren't allowed to send him emails. He would actually come out and yell at you if you sent him an email.
What was the reason?
It was never given, which was extremely worrisome, because normally the reason why you have a compliance and diligence department is to actually have written policies about what you're doing, to be able to explain to people how you're making your decisions. So it's exactly the opposite of what you would normally expect.
And when you say to review the quality of the loans, if you could,
Sure.
for people who are not aware,
Yes.
you were in essence certifying that these individual loans could be packaged into a group of securities to then be sold to investors in a huge package, right? But you had to go through every individual loan? Was that?
Yeah, that's pretty much what happens. It's really that you're taking the actual loan files that was done between the lender and the borrower and looking at them to make sure everything looks right. Does this person have enough money to pay off their loan? Do they have the sort of history where we think that they're going to pay this loan? And if we find that they don't, then we're actually not supposed to purchase the loans, and certainly shouldn't be selling them to other investors without at least telling them there's something wrong with them.
And so what was the smoking gun for you?
Everything about what really started happening in particular became apparent in October was that sometimes we had deals coming in where even though I wasn't even the person looking at the loans, you could tell from where I was that something was wrong with them. The Greenpoint deal, which is what Matt talks about in his article, even when the loans came in, they were very, very old, which usually you try to actually pool these loans and sell them within 2 to 3 months. These loans were going back to close to the beginning of the year. If you work in the industry, you know immediately what that means is either they couldn't sell them because the buyers were telling them they weren't any good, or even worse, they'd been sold and then had missed a bunch of payments, so they'd actually been sold back to the originator. Any of those loans you wouldn't normally sell to investors as regular loans.
Geneva might be considered one of the smallest financial capitals in the world, but it's among the leaders when it comes to financial trading and offshore asset management. Besides private Geneva bankers, it's also home to branches of the biggest international financial institutions. Until recently, not many questions were asked when rich clients brought their money to these classy addresses to avoid the tax authorities. Business was thriving until data theft cases, like the one involving HSBC, brought the extent of tax dodging to the surface. For Yves Mirabeau, president of the bank bearing his name, data thief Hervé Falciani shouldn't be considered the person who buried banking secrecy.
The real reason was the desire of countries to look for new sources of income as a consequence of the 2008 financial crisis to cover their own deficits.
Because of the zeal of the states in need, everything went much faster than bankers and tax specialists could have ever expected.
We were all taken aback. In 2009, bankers believed if they handed over information upon request, they wouldn't be troubled again for another 10 to 15 years. But what happened afterwards was a tsunami, and as a result, we now have the automatic exchange of information in place.
These changes have left their mark on Geneva as a financial centre. In 2005, there were 145 active banks, and today there are only 119. It's worth noting that over the same period, the number of employees in the sector has increased from 16,644 to 18,855. This is a consequence of the fact that it's now more demanding to check the tax history of clients. Nonetheless, the new clean money policy hasn't led to a drop in the amount of assets under management. Geneva's reputation remains intact.
There is more money flowing in than out. The number of managed assets went up, despite the difficult situation on the markets, despite the decision of the National Bank to remove the franc peg to the euro, which was a big blow to our clients. In spite of everything, we're seeing an upward trend.
Geneva as a financial centre was shaken by the HSBC affair, but thanks to the radical change of course, it's maintained its leading position in asset management.